Thanks for clicking. Canada could be seeing tougher mortgage qualification standards in the near future. This according to Peter Routledge, head of the Office of the Superintendent of Financial Institutions, at a conference on Monday. As we talked about in December and the fall, OSFI has been resisting, or shrugging off, calls from some Canadians to loosen mortgage stress test requirements in order to prop up the housing market.
Gee, I wonder who the benefactor could be.
But the comments coming from Routledge on Monday are indicative of a regulator that is not only shrugging off or laughing off those pleased to loosen its policies, but rather a regulator that is looking to tighten its policies, which will no doubt put even more downward pressure on the price of Canadian real estate. So what I want to do today is go over the comments made by Routledge, discuss some of the implications for Canada's housing market should we see these new rules come into effect, and then discuss what to look for next. As we'll see, Routledge's comments come ahead of a meeting by OSFI, which is set to occur later this week, where the regulator is considering more stringent rules for Canada's banks. We'll obviously have an update out on the outcome of that meeting and any changes to Canada's mortgage rules on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into these comments. On to Routledge's comments. During an RBC conference on Monday, Routledge noted that although the mortgage stress test has been successful at limiting risk to Canada's financial system, it's not the only tool at OSFI's disposal. Indeed, given increased risk to Canada's economy that could put more strain on the financial system, OSFI is questioning whether or not the current mortgage stress test is sufficient to protect the system from mass defaults. As such, Routledge said that the regulator will look at a broader range of debt serviceability tools, including debt-to-income constraints, debt service constraints, as well as the current interest rate stress test tool. And by debt-to-income constraints and debt-to-service constraints, Routledge is talking about the gross debt-to-service ratio, or GDS, and the total debt-to-service ratio, or TDS. The GDS measures how much of a borrower's gross income, their total income before taxes, goes towards servicing their property. The principal payment, the interest payment, the property tax payment, and the heating. As of right now, the industry standard, and that of CMHC, is that borrowers with a credit score of over 680 can have a GDS of 39%. So the principal, interest, taxes, and heat can represent a maximum of 39% of a borrower's total gross income. For borrowers with worse credit scores, for credit scores less than 680, it can only represent a maximum of 35%. And then the TDS, the total debt to service ratio, represents the GDS plus all other debts. So the credit cards, auto loans, lines of credit, furniture loans, etc., etc. Right now, for borrowers with a credit score of over 680, that can represent 44% of their total gross income. For those with credit scores less than 680, the maximum is 42%. And while these GDS and TDS scores are more industry standard rather than regulated by OSFI, that in fact can change. And Routledge is saying that OSFI is going to be looking at these requirements at their meeting later this week. And were OSFI to tighten these requirements, that would obviously lower the total amount of buying power that Canadians have when they're out in the market, which obviously would put downward pressure on our prices. More so. Indeed, Toronto Regional Real Estate Board President Paul Barron recently noted in a report that with no relief from the Office of the Superintendent of Financial Institutions, OSFI, mortgage stress test, home selling prices adjusted downward to mitigate the impact of higher mortgage rates.
This is all your fault!
As we've seen time and time again, tougher mortgage qualification standards, lower buying power equals lower prices. But OSFI has said before, and will probably have to again, when they were talking about the stress test, that the regulator is not concerned with stimulating or restricting housing demand. It sees its role, quite rightly, as a banking regulator. Its job is to protect the Canadian financial system. It's not concerned with the housing market. When the Bank of Canada raises or lowers rates, as we've seen over the past few years, it very much understands what the result of those rate hikes is going to do to the housing market.
Yeah, wow, they really should have told me that.
But when OSFI changes the rules, when it considers beefing up lending standards, it is doing so to protect the banks, to protect the financial system. What happens to the housing market is almost collateral damage. The housing market is not so much considered in the same manner as it's considered when the Bank of Canada makes a policy change. With that said, if OSFI does decide to make these rule changes, if they do make mortgage borrowing even more difficult for Canadians, I don't expect that to happen overnight. Similar to what we've seen with the implementation of the stress test in previous rounds, we will have some time before these rules take effect. And during that time, I would expect to see at least a brief blip of housing prices as buyers rush in to beat the mortgage qualification standards. We'll also probably see sellers rush in, so that could even out, but time will tell. Speaking of time will tell, all of this is based off of these comments coming from Routledge, and we don't have any concrete knowledge of what OSFI is going to do as of yet, but we will obviously have an update out on any changes on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.